At Post 9 with his take is former Federal Reserve Vice Chair Richard Clarida. Boy, you got out just in time for this craziness in the world of central banking. What is this going to work? What the British Central Bank is trying to do?
Well, I think it will work. They're putting their full faith and force behind it. The real question for markets is what happens in a month when this program is over. And obviously, they're hiking rates. So right now, it's a little bit of an awkward situation to be tightening policy and intervening. But I think they explained it very well. So we'll have to see.
I mean, the real question is what's going to happen with the government's policy and these tax cuts and expansive policy at a time where they're trying to fight inflation, getting a rebuke from the IMF.
Wow. It's been a while, huh?
That's like an emerging market.
Yes, yes. Well, anyway, obviously, the new government came in with its own ideas on tax policy at a time when the Bank of England is trying to reduce inflation. So they're trying to work it out in real time, and that's what we're seeing, I think.
So the question is can you invest in that country right now, given these opposing policies?
Well, certainly, if you do invest right now, there's a lot of volatility that you're going to have to stomach. So I imagine a lot of investors will be on the sidelines to see how this shakes out.
Mary Erdos was on a panel with me at Delivering Alpha today. Listen to what she said about potential investment opportunities in the UK.
Last week, people said, don't invest in a single thing in the UK. That is exactly when people like us and people in the room think, let's go look right there. I think UK banks might be the most interesting thing you could invest in.
UK banks in this kind of environment. What's ahead for that economy?
Well, obviously, inflation's way too high, and there's a new government in place, so there's a lot of uncertainty. Look, sir, the global economy, inflation's too high in most countries, and most central banks are tightening, and there's going to be a slowdown as a result of that, as well as Ukraine. So I think you can't paint a rosy picture right now.
All right, so now there's the question of the Fed, which it looks like markets are stable in this country. Do you think that they would intervene or pivot like the UK did if we start to get sort of out of whack with our bond market? Is that what the market is trying to figure out today?
I think the hurdle to do that is very high and appropriately high. But certainly during my time, we saw periods of dislocation in the Treasury and the repo markets, and the Fed does have a financial stability responsibility. My bottom line is I think the hurdle to do that is very high, and I don't think they're expecting to do it. But one thing I learned in my 3.5 years is never say never. So I won't give you an absolute no.
We're getting a lot of Fed speak these days.
Oh my, yeah.
And you can help interpret this. Today we heard from Raphael Bostic of the Atlanta Fed. He said, and I think we have the quote here, we have to get to a moderately restrictive stance. And for me, that is in the 4.25 to 4.5 range for our policy by the end of the year. My preference is we get there by year end. Interpret that for us, if you would. Well,
right now, sir, we have an unusual situation where virtually every Fed speaker is singing from the same hymnal, the same playbook. Under Chair Powell's leadership, there's really been a hawkish pivot this year since the March meeting. I think the chair made it very clear. He thinks rates are going to that level that Bostic referred to, 425 to 450. I do think there's a sense on the committee to get the hard medicine out of the way this year. I really do think that they're trying to front load as much of this as they can. And then hopefully next year the data starts to improve and they can pause. And I think that's certainly what they're thinking right now. That's what the SEP indicated.
So 75 November?
That's what I would guess right now. 50 in December, and then one more hike either in January or March of next year. I think is what I call the plausible best case scenario.
And then they pause.
And then
because
they pause.
Why?
They'll pause because they will have done a lot, and many folks, including Vice Chair Brainerd, has said at some point it will be appropriate to step back and assess. But again, it is going to be data dependent. They're hoping the inflation data starts to improve. It's been slower to improve than they and others thought. But I think the baseline is next year that we do get a pause. But they'll push back against a cut. You know, when Jay Powell says pause, the markets will hear cut, and they will definitely try to push back against that.
Well, I think it depends how bad the economy turns and unemployment gets.
Yeah.
What is your guess on what happens there?
Well, I do give the committee credit for, I think, being more realistic that some pain is going to include a rise in the unemployment rate. Now, admittedly, from a very low level, 3.5% recently, I do think in the end that to get inflation down into the twos will probably require a larger increase in unemployment, say perhaps up to 5%. So that would be 1.5 points. Whereas they have a little bit less than that right now. So I do think that they're moving in a more realistic direction on the projection. But we can't kid ourselves. Inflation's too high. The Fed started in March of this year to hike, and there will be some time before we see evidence that inflation's coming down towards 2%.